Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, IFG, and Dunham & Associates Investment Counsel are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.
If you're nearing retirement or worried if what you've saved is going to last, then this is the podcast for you. Now let's join Cornerstone co-founder Jamie Avila for the Cornerstone Retirement Blueprint Podcast.
My name is Jamie Avila. I am the managing partner of Cornerstone Wealth Management. And as you've been tuning into the podcast, you kind of understand that we're a financial wealth consulting company. One of the things that really sets us apart here at Cornerstone is that we're a full brokerage, meaning that we do a lot of everything. And so some of the things that we've been kind of delving into have been on estate planning. And so we have Sal Capizzi, the executive vice president of Dunham Trust Company. And we're going to be talking to him today about kind of a niche charitable planning technique that some of our clients have been able to engage in. And of course, Sal has a ton of stories of clients that he's been able to help using what we call a donor advised fund. So we're going to be tackling that today. Welcome, Sal.
Thank you. Pleasure being here.
Yeah. And did you take the long trip? Was it from Southern California?
Yeah. So it's nice that today in Las Vegas we have San Diego type of weather.
That's true. Well, we've had it almost the last 2 months. It's been great.
Yes.
And so we can't complain here. But thank you for coming up. So one of the things that I guess the first question I want to ask, because most people when they hear the word donor advised fund, they're like, say what? What are you talking about? Maybe you can break that down for us on what a donor advised fund is, and then we can kind of explore a little bit more from there.
So think about it, Jamie, in terms of a family foundation. So you hear about rich people putting $1 billion into a family foundation, and the purpose of it is so they can spread good. They can make contributions, make donations to organizations that are doing wonderful things on our planet, right? A donor-advised fund is a similar type of structure. So what you do is you make a gift to the donor-advised fund.
Okay.
It is an irrevocable gift. But the name is Donor Advised Fund. So what does that mean? It means that if I, as the donor, if I were your client and I placed money into the Donor Advised Fund, I'm called a donor, right?
Gotcha. Yep.
And by the way, just so everybody or your listeners know, so Jamie, his instructions right before we went on the air, he said, please, and you know he's a big guy. He said, please, he said, do not use jargon. You have to explain what you're talking about.
That's the Achilles heel of our industry, right? We kind of sometimes talk too high over clients' heads.
I agree, right? So a donor is simply the person who donates into the fund, right? So I, as the donor, right, I place money into the fund, but they call it a donor advised fund because just like a family foundation, you are going to determine how that money is spent and when the money is spent. Now, contrast that to if I'm just giving $10,000, let's say, to my church.
Right.
When I give them that money, I'm done.
Yep.
Right? There's no further advisement on my side. Right? If I place money into a donor-advised fund, I can give money to my church. I can give money to my school. I can give it to the San Diego Symphony if I so desired. Right? But I make those decisions where it goes and when I make those contributions. If I decide that I don't want to make any contributions in 2022, then I don't. Right.
Interesting. So a donor advised fund, you can almost front load it with maybe a little bit more money than your annual contribution.
Wow. So so you nailed it. right? Because one of the ways that you take a look at a donor-advised fund is what a concept we call bunching, right? What bunching
I'm going to write that
mean-
down because I actually kind of like that word. That's bunching. Okay.
But what that simply means is that what you're doing is you're placing several years of contributions all at one time, right? And
That's
I'll
interesting.
explain
That's
why
interesting.
you would do that. So the point is that let's assume for a moment that my charitable giving is a total of $10,000 a year.
Okay.
Right? One of the reasons you might do that is because if your listeners are not a business owner, right? So you as a business owner, you've got plenty of deductions that you take, right? If you are not a business owner, you're likely taking the standard deduction.
Absolutely.
Right? So this year it's $25,900. All right. So walk through me just a little bit of math, right? Work with me on this. So on so what can you deduct? Well, you can deduct up to $10,000 of state and local taxes. Mm-hmm. That's capped. You can never deduct more than that.
Mortgage, maybe?
Mortgage interest, right? Not the mortgage payment, but how much of the interest it is that you're actually paying. So let's assume just for a moment that it's $6,000 a year. I've had my house for a while. Most of it is amortization. It's $6,000, right? So I have $16,000 of deductions. And assuming that I'm in good health, I don't have excess medical bills and other type of deductions, that's all I have. Right. Well, if the government's going to give me $25,900, but I only have $16,000 of actual deductions, which one am I going to pay?
You're going with the standard, right?
Yeah, of course.
Yeah.
Right. But let's assume just for a moment I'm also giving $10,000 in charitable contributions a year. So I said we were at $16,000. But I make $10,000 of charitable contributions. So 16 plus 10,000 is 26,000. The standard deduction is 25,900.
Right.
Which one am I going to take?
Yeah. Well, the higher
I'm going to take the 2,600. Right. So that means that my $10,000 of charitable contributions, all they're giving me is $100 of additional deductions. If we assume for a moment that I'm at a 30% tax bracket, right, that means that it's a $30 tax savings. Right? But what if we bunched my contributions? What if I said, you know what, I'm putting $10,000 a year in to various organizations. So what I'm going to do is I am going to take 5 years of those contributions, $50,000, and I'm going to place it in a donor-advised fund. The beauty of a donor-advised fund is you get the tax deduction in the year that you make the investment.
So this is really cool. So this bunching effect that Sal's talking about is you're taking 5 years of charitable contributions, front-loading it all in 1 year. And why would you do that? Well, some of the reasons why might be you want to do a Roth conversion and you need a deduction to maybe counteract that, right? So if somebody's serious about maybe, taking their IRA and converting it to a Roth, typically they have to pay the tax on that.
Correct.
And, they're going to get the tax-free growth after that for the rest of their life, but they have to deal with the taxes today. And that's not such a bad thing with taxes being as low as they are. However, this could be another way for you to get a little extra juice to offset that conversion.
Right. So in other words, your listeners need to write down a super bunching. So you're discussing a concept
Super
called
bunching.
super bunching.
I got to use that.
But just to finish off on this concept. So now I what I did was I put 5 years of contributions in my donor advised fund. Before I was getting $30 a year, right, of tax benefit times 5 years. That's $150. If I put $50,000 in this year, my donor advised fund, and remember, I'm still going to make the same $10,000 contribution each and every single year because I control when I do it. I control who I give it to once it's in, but I get an immediate tax deduction. Now I have $50,000 on the charity. I have $10,000 in state tax. I have my $6,000 of mortgage interest. That's a $66,000 deduction that I'm receiving today. I'm going to be $40,000 above the standard deduction, right? So basically at that same 30%, right? 40,000 times 30%, that's a $12,000 tax savings, not the $150 I was going to get, the $30 every 5 years. I now have a huge tax deduction. And guess what? In 2023, I get that $25,900 standard deduction anyway. So I get both. So it's a wonderful way of spreading your good, but also now receiving more benefit for the good that you're distributing. So if you have $12,000, use $6,000 to go on a nice vacation with your family and give $6,000 more to your church.
That's great.
Whatever it is that you want to do.
Or whatever it is, yeah. So now my clients or my listeners don't know the answer to this, but I do. But I'm going to ask you, what is the other benefit on putting that $50,000 in the donor advised fund as to the growth on that?
Yeah. So tax-free growth.
Okay.
You see, because the donor advised fund is what's called a 501c3. That's a tax code that says that if you do these things, you are a charity. And if you are a charity, then you have the ability to avoid all taxation. You're simply not taxed. So all the money in that fund is going to grow tax-free. Now, do you want your head to hurt?
That is awesome. I mean, you think about it. Tax deduction.
Yep.
And tax-free. Mm-hmm. And who knows, depending on what you have that money invested in, that $50,000 could grow actually much larger over that period of time, so that you can do even more good than your initial intent.
Exactly. And now, and this is the part that all your listeners, their head is going to start to hurt. But we spoke about putting $50,000 in, right? And we're thinking of writing a check from your checking account, right, into the donor advised fund. But what if? Jamie, what if instead of putting cash, what we did was we took a look at a most highly appreciated asset.
This is the best part. I love this part.
And placed it into the donor advised fund.
Sal, you're a genius. All right.
I wish I had invented this. I didn't.
Did you come up with this?
No, I didn't.
Okay.
No, I didn't.
Well, I want them to understand. So it's almost like the trifecta here, right?
Correct.
Because you have tax deduction, you have tax free, and like you said, why not take a highly appreciated stock or something that you've been deferring and move that in there and not pay tax on that?
Correct. Because now all of that capital gain, because remember, the fund is a 501c3 organization recognized by IRS. So when you sell that, you eliminate the capital gain. So $50,000, if we assume for a moment that, let's say, the half of it was all capital gains. In Nevada, you have a 20% federal tax, right? So you've saved 20% on that $25,000, and you still get the $50,000 deduction on top of that, right? So it's just a wonderful way of doing good and maximizing the tax benefit of the good that you do.
Right, and it depends on how much you have long-term capital gains, right? Because the long-term capital gains is 15% if it's long-term, right? But if it's over a certain threshold, it goes up to 20%?
Correct.
Yeah. So it's all, it depends on their own situation financially.
Correct.
How much pain they're going to avoid.
Correct.
But nonetheless.
That's the reason they speak to you, Jay.
Yeah. Nonetheless, they're avoiding pain. And so this is why I wanted to have you on here, Sal, because you are just a plethora of knowledge. And this is something people need to know about, because I have clients that we're on a mission. They're already giving contributions, and they're just not benefiting as much as they could.
And let's go back to your concept. You said, you know what I'd like to do with my clients. I like to, when I'm doing Roth conversions and things like that. Anytime that you have an excess amount of taxable income in a year. So you may have sold something. You may have a Roth conversion. And Roth conversions is a wonderful way of doing this exactly for what you just said. If you're doing it anyway, if you're making contributions anyway, then why not it's 10 years worth of it, right? And then with the tax savings, convert your Roth from a regular IRA to a Roth IRA, eliminate RMDs, tax-free growth, and your family receives the asset in a much better tax situation than a regular IRA.
Well, this has been great, Sal. Thank you for coming
My
on
pleasure.
the show and talking about something so important. This is part of a 3-series that we're doing with Sal. The first one, of course, is on donor advised funds, which we've been talking about. We're also going to be talking about CRTs, Charitable Remainder Trust. And then we are also going to be talking about something that's kind of proprietary at Dunham Trust, which is the IRA Trust Trilogy, which I like that name. So we're going to be talking about that. So if you're sitting there listening, saying, you know what, this kind of sounds like something I need to learn more about. I need to really understand what this donor advised fund is and how it applies to me in my situation. Pick up the phone, give us a call here at Cornerstone, shoot us an email, and one of our advisors will be able to sit down with you to go over whether a donor advised fund is right for you in your situation. Sal, it's been great. Thanks for spending some time with us, and we look forward to some of the other shows that you're doing.
Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, IFG, and Dunham & Associates Investment Counsel are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.